What is leverage? When it comes to leverage, perhaps we will recall the seesaw we played when we were young, and also recall Newton's famous line, "Give me a fulcrum, I will warp the whole earth." The image of leverage is not unfamiliar to us, and its essence is to leverage to achieve the function of a small against a large. So in the financial market, how will leverage play its role? In fact, leverage is very common in financial markets, especially in areas such as the stock market, bond market, foreign exchange market, and derivatives market. And leverage is used in the material world to pry a larger object with a small amount of force. Similarly, in the financial markets, leverage allows investors to control larger assets with a small amount of money in the expectation of higher returns from them. What is leverage? The concept of leverage is the use of a small amount of one's own capital to leverage a larger investment through borrowing or the use of derivatives. Specifically, an investor can borrow money, for example from a bank or brokerage firm, and use that borrowed money to make an investment. If the investment is successful, the gains will be magnified, but if the investment fails, the losses will also increase accordingly. This way of obtaining returns by amplifying the use of funds is leverage. Is it a bit of a head-scratcher? Let's take an example. Let's say you have $100 of your own money, but can get another $900 of funds by borrowing so that you will be able to invest $1,000 in assets. At this point, you have a leverage ratio of 10x, meaning that $100 controls a $1,000 investment. If the asset appreciates by 10%, your return will not be a mere 10%, but will be magnified to 100%. But conversely, if the asset depreciates by 10%, the loss is also magnified by a factor of 10. So we understand the concept of leverage. How do we make it work for us in the financial markets? First, we need to understand some common forms of leverage. There are many types of leverage, and we're focusing on two today. Debt leverage. This is the most direct form of leverage, where an investor borrows money from a bank or financial institution for investment purposes. This form is common in the real estate market and corporate finance. Throwing all this theory aside, let's look at how it can help us make money. Let's say you have $200,000 of your own money, and you can take out a bank loan for $800,000 and use that $1 million to buy a property worth $1 million. In this case, you have leveraged 100% of the value of the property, $1 million, with 20% of your capital, $200,000. If the property increases in value by 10% and the total value of the house rises to $1.1 million, your actual gain is $100,000, which is equivalent to a 50% rate of return on its own funds, not 10%. Derivative leverage. Through derivatives such as options and futures, an investor can control a large amount of assets with a small amount of capital. This leverage is achieved through the structural features of derivatives. Let's move on to how to earn money. Suppose you think the price of crude oil will rise in the future. You can agree with someone to sell $100,000 worth of crude oil in the future, but only pay $10,000 on margin. If the price of crude oil rises 10% as expected, you make a profit of $10,000 on the trade, and your return is 100%. However, if the market moves unfavorably and the price of crude oil falls by 10%, your losses are magnified, and you could lose your entire margin. At this point, do we have some feel for the application of levers? Are you interested in practicing it yourself? Let's try to leverage large sums of money together and take the first step to becoming a financial giant. Let's say you have $100,000 and you have your eye on a $1,000 property that is expected to appreciate to $150 in the next year. How would you proceed? Option A, borrow $900,000 to buy it. Option B, wait for the next opportunity. It's worth trying to borrow $900,000 and then sell it the next year, and you've managed to make $500,000 on $100,000. Congratulations. I believe we can appreciate the advantages of leverage from what we have just done, which can magnify an investor's potential return. For example, if an investor is bullish on a stock, he can use leverage to magnify his returns. In a rising market, leverage can deliver very attractive returns. As a result, leverage is often favored by investors who want to accelerate their wealth accumulation. So let's summarize both the advantages and disadvantages of leverage. Leverage is a double-edged sword. For individuals, leverage can magnify investment returns, while for corporations, leverage can be used to improve the efficiency of capital utilization, investing limited funds in more areas, obtaining higher returns while reducing unsystematic risks brought about by a single investment strategy. However, in the world of finance, there are no permanent winners. As seen in the second example, the use of leverage magnifies gains while potential losses are magnified by the same factor. If an investor's expectations of the market are wrong, or if the market fluctuates dramatically, leverage can expose the investor to significant debt stress and the risk of margin calls. This was particularly evident during the financial crisis. In 2007, the real estate market slumped, home prices began to fall, and many borrowers were unable to repay their subprime mortgages, leading to massive defaults. The deterioration in the subprime mortgage market was transmitted to the financial system, and the value of the securities held by Lehman Brothers related to those loans fell sharply. Falling asset prices put Lehman under pressure to repay its short-term debt, while high leverage made it difficult for the company to quickly generate enough cash through asset sales. At the same time, the market questioned its solvency, and investors withdrew their funds in panic, further exacerbating Lehman's liquidity crisis. Despite Lehman's attempts to sell its assets, seek external capital injections, and even look to the government for a bailout, confidence in the financial markets collapsed as losses continued to mount. On September 15, 2008, Lehman Brothers filed for bankruptcy, making it the largest bankruptcy case in the history of the United States. This event triggered violent shocks in the global financial markets, freezing credit markets, plummeting stock markets, and leading to a worldwide recession. The importance of Lehman Brothers in the global financial system was such that its bankruptcy triggered a widespread chain reaction, with many other financial institutions also in trouble. Leverage amplifies returns. Leverage can dramatically increase returns when markets are rising. Leverage helped Lehman make huge profits during the real estate boom. For example, a $3 billion investment could generate a 300% return when home prices rose 10%. Leverage magnifies risk, but when the market falls, losses are similarly magnified. If house prices fell by 10%, the value of assets fell to $2.7 billion, and Lehman Brothers could become insolvent as a result. High leverage not only leads to greater losses, but also exacerbates financial distress. Crisis of liquidity and market confidence. Leverage also affects liquidity. Once assets are devalued, institutions must sell them quickly to pay off their debts. However, in times of market panic, illiquid assets make it difficult to find buyers, further depressing prices and worsening a firm's liquidity crisis. The bankruptcy process of Lehman demonstrated that loss of market confidence and liquidity shortages can rapidly exacerbate the distress of leveraged firms. So how do we control the enormous power of leverage and gain returns while managing risk? In order to cope with the risks associated with leverage, investors and financial institutions need to take a number of risk management measures. First, it is important to set a reasonable leverage ratio. Excessive leverage can bring unbearable risks, so regulators in many countries have strict limits on the level of leverage. Second, investors can use stop-loss strategies to limit potential losses. For example, in the stock market, if an investor sets a stop-loss price, when the stock price falls to a certain level, the system will automatically sell the stock to avoid greater losses. In addition, diversification is also an effective means to reduce the risk of leverage. By diversifying funds across different asset classes or markets, investors can reduce the risk associated with the failure of a single investment. Overall, leverage is a very important and powerful tool in the financial market, which can help investors and enterprises to expand the scale of their investment and returns with limited capital. However, at the same time, leverage comes with great risks, and investors need to be cautious, use leverage wisely, and take appropriate risk management measures. I believe that from this video, you have a more profound understanding of leverage. I hope you can learn finance at the same time. Dare to apply the knowledge in practice. In the market, boldly operate without fear of the wind and waves. Because finance can not only bring us rational thinking and sharp perspective, more importantly, through practice to obtain the courage to operate in the face of adversity, the face of failure and the unknown calm, as well as with the market when the certainty of going in the opposite direction. These are the unique charm of the financial market, but also the indispensable quality of life. Thank you for watching. We will see you next time.